A very good morning. A warm welcome to all of you to this monthly webinar series conducted by Virtuoskill for its Vlearn community members. Starting at the right time is important, and we will strive toward this goal always. Before we formally introduce you our speaker for the session, let me share a brief introduction about this webinar series. My name is Kalyan Raman, and I am co-founder of Virtuoskill, the hybrid skill development platform of VirtuoWeb Private Limited. We have completed 12 years of our existence. We are passionate about skill development. Our mission is to make young India ready with the skill sets for the future. We are India's first digital learning platform to provide a certified mortgage professional program. We work with banks, housing finance companies, and non-banking finance companies in the areas of skill development. Till date, we have skilled more than 5,000 plus professionals in our classroom sessions and more than 10,000 plus learners in our digital learning platform. We are committed to make the journey of learn, skill, and grow possible by introducing learning opportunities as your best and lifelong friend. In this initiative, we have created a Vlearn Community of Learners on Virtuoskill platform. The membership is open to learners subscribing to the course and professionals from the industry interested in upskilling. Let me now formally introduce you to the speaker of today's session, Mr. Lakshmi Narayanan Duraiswamy, Managing Director of Sundaram Homes. Mr. Lakshmi Narayanan comes with more than 30 years of experience in financial services industry with expertise in risk management, operations, and strategy. Prior to Sundaram Homes, he was Chief Operating Officer of Sundaram AMC till 2019. He joined Sundaram Asset Management Company in 2009. He worked for GE Capital, India, and as well as in Australia in various risk management and business development roles across commercial finance, consumer finance, and healthcare. He started his career with Citibank in retail operations before moving to GE Capital. Mr. Lakshmi Narayanan is a commerce graduate and a qualified cost accountant and Master of Business Administration from Loyola Institute of Business Administration, Chennai. He is also a member of the Managing Committee of Madras Management Association. Now, let me hand over to Mr. Lakshmi Narayanan for his webinar address. Over to you, sir.
COVID was probably the final nail that hit this sector. But with every challenge that was thrown in, the sector found a way to get up and then continue to grow and show its resilience. And here we are post-COVID. This is probably one of the fastest growing sectors in the financial services space right now. The other reason why the growth continues to go well is, some of the other things that I've mentioned, where affordability has increased, the rising pace of urbanization in the country, and also growth beyond metros. One interesting factor in the last 4 to 5 years that has also happened is the muted investor demand. Prior to 2016 or 17, I would say, we've had a lot of investors coming into real estate that had two things. One is, little bit of a artificial euphoria that got created, but also it drove up prices unreasonably in some segments of the market. People used to call it as a flip. You book an asset, you book a home with a developer, and even before the construction is complete, in about 3 to 4 years time, you can flip it over without even taking possession of the house, because the market was in a euphoric mode and prices were rising. But that's no longer the case. So that actually drove the investors away. When the investors go away, the purchaser is now the end user of the asset, and therefore the prices have kind of become a bit reasonable, and also demand has become stable. The other thing that has changed since COVID is also the changing preferences of the customers. There has been talk about people wanting to move to larger apartments or villas, moving away from the city centers. Initially, people thought this was to do with the work from home that the companies offered, but I no longer think that's a sustainable workplace, because no company today even offers a 5-day work from home. Typically, even the IT companies that do work from home, they offer you 2 days work from home or a 3-day work from home. So you can't be far away from the city. But the other thing that has also changed is the connectivity between the city, within the city. The metro rail network is redrawing the map of most of the cities, making a lot of far off locations now accessible and in a greater speed of time. We spoke about beyond metros. Tier 2, Tier 3 towns are probably going much faster than the metros today. That's thanks to infrastructure development, thanks to industrialization of smaller towns or towns beyond the top 6 or 7 cities in the country. And the low mortgage penetration. India is at a mortgage to GDP ratio, which is one of the usual indices that is measured to look at the mortgage penetration in the country. We are somewhere close to about 10 to 11%. Just to put it in perspective, most of the Asian economies will be about 20 to 25%. US and UK is about 60, and Australia is probably at the top of the charts at nearly 100 to 110%. And our closest competitor that we always compare, China, is about 18 to 20%. So therefore, there is still a lot of headroom for growth in terms of what the mortgage penetration can do in India, and therefore drive this sector. Where are we in the cycle? Typically real estate as an asset class goes through the usual 4 cycles, which is your recovery cycle, where the prices recover and people find sweet spots, and then developers begin to offload inventory. Then you have a period of expansion where there is stability, there are new investments that are coming up, and customers start coming in. When customers start coming in, what happens is the next phase of cycle is typically your hyper supply. Looking at the demand and looking at the money that people are making, hordes of developers come into play, and then suddenly supply outstrips demand, leading to a glut of inventory, and therefore that leads to possibly a recession cycle. How long will that be? Will each of these cycles be for 5 years, 7 years? Nobody knows, because past is no longer an indicator of what the cycles are. The other thing that's also happening with the cycles is the tenor of these cycles are getting shorter. It's no longer 7 years in each of these cycles that we find. It's probably 2 years, 3 years, or 5 years. But this is typically the cycle that if you've been long enough in the industry in terms of real estate or in terms of real estate financing, you will know that nothing lasts forever. And there's also this talk about easy money theory. When there's too much liquidity in the system, is this what that is fueling the real estate boom in the country? It is very hard to call that, because no longer is the money cheap today. With the successive rate hikes, we've had fair bit of raise in the interest rates, and the nature of the inventory disposal by the developers, or the geographical expansion of this real estate development in the country across tier 2, tier 3 towns, etc., makes it hard to believe that it's just a liquidity driven boom. So we'll have to wait and see, but at least there are no indications that this is a easy money finding its way to an asset class yet. Impact on demand, we really don't see string of interest rate hikes over the last 12 months has any immediate effect on the investor demand, on the buyer demand. But it's also the fact that if you go back 2 years pre-COVID, between 2018 and 19, and look at the interest rates and compare it to where we are today, the numbers are not too dramatically different. So we've had a period of 2 years during COVID where the rates were artificially kept low to boost demand, and we are now back where we need to be, because we now talk about everything at pre-COVID levels. The growth has to come in, profitability has to come in. So therefore, it is natural that interest rates will also go back to pre-COVID levels, and to that extent, it's par for the course. So now I'm going to talk about a few random topics around the housing finance space. Let's talk about technology. Technology is what keeps us in the game today. Technology is not something that we can take it lightly. It's almost, I was giving this example when I was talking to Kalyan yesterday. It's almost like saying, I open a bank account. Do I get a net banking facility today, or is it something that I need to sign up for? I mean, you won't even open a bank account today if you don't get a net banking, and no longer is net banking relevant. People want mobile banking. So therefore, technology is something that we need to focus on. Technology is the productivity engine. You know, there's a lot of talk about productivity today in across all businesses. How do I make how do I make more with what I have, or more with less? And that less has to come from, that productivity has to come from technology, not from adding people. Or you can tweak processes, you can add people, you can get 5% more, you can get 10% more. But if you're saying, I want to get 2x more or 3x more with what I have today, you got to find a way to use technology. And technology can be for a seamless customer experience, or making your employee effective and get productivity gains from there. There are lots of companies that are doing digital-led distribution, where online apps are available, tools are available for people to log in customer applications, and then underwriting happens seamlessly today. Predictive analytics, predicting buyer behavior. What are the odds that a customer will take a further loan? Can I top up? Can I cross-sell to customers? There are significant long-term advantages of using technology. There are costs, there are upfront costs that we need to invest, but this is no longer a nice to have. We can evaluate the cost benefits of what technology will do, how much will it benefit, etc., whether it will pay off in 3 years' time or 7 years' time. All of those debates can happen, but it's not something that we can relax and say, I'll wait for 2 more years and make that call. I don't think, if we've not invested in technology now, we are already past the gate, and we still need to, figure out how to get there. So this is no longer a nice to have, and this is probably a core of financial services today. The role of banks versus HFCs or NBFCs, as we call them. Banks are here to stay. There is a play for all. It's no longer that banks are eating into NBFCs share, or NBFCs are eating into bank share. We can't wish away banks. And with HDFC now merging with the bank, now becoming a bank, banks will have a disproportionate share of the housing finance pie, and that's understandable. I mean, even with HDFC, we still had about 65% of the share going to banks, and now probably it will be about 80% or 85% or so. So there is play for all. It's not that banks are eating into our share. There is room for everybody to play. What is interesting over the course of the last 3 to 5 years is the public sector banks, ex-SBI, have actually upped the game and are pushing the boundaries. A lot of these public sector banks are getting their act together. They've seen that what an SBI can do, and some of these banks are seriously large enough that in the context of SBI they may look small, but if you keep SBI aside as one big daddy, and then look at the rest of the banks, these are 6 banks with 5,000 and 6,000 branches everywhere, and they can give all of us a serious run for the money. So the banks are getting their act together. That does mean that there is a serious margin compression that's happening. Banks are figuring out how to do this retail underwriting, retail sourcing, and retail underwriting. There is still an arbitrage. The bank sourcing mechanism is still not yet perfected. So that does give room for NBFCs, HFCs to work with those arbitrage as while they exist. But HFCs will also have to up the game to fight all of these things to stay relevant. So margin compression is here to stay, and this is not just in the metros or in tier 1 cities. Margin compression is happening in smaller towns. So therefore, this is something that we've got to live with. and banks take the home loans as their perpetual book, because it is something that banks do very well. They have a large client base. They have the savings account, current account of the customer. They have the payment patterns and the payment behavior of the customer handy. So if banks make a 5% push towards getting their processes right, they will probably make a significant dent in the overall housing pie as we see this today. There is also the sourcing channels that are undergoing a bit of a transformation, with a couple of large banks setting up their own captive channels as a sales outfit of the banks. At least two of the top banks, one private sector bank and a large public sector bank, comes into mind. So where their ability to hire talent is not inhibited by the banking infrastructure that they are present, and their ability to go local and then hire quickly and manage that channel differently from the banking channel. So this is making a big difference to the way the banks are making the push towards sourcing home loans and retail loans in general, not necessarily home loans, retail loans in general, including your credit cards, unsecured loans, as well as auto loans and home loans. Digital is making a foray. It's still not the biggest channel yet, but it's making an effort. Over the course of the next 3 to 5 years, I would still think that digital will make a big foray into the channel mix and the sourcing mix of most of the HFCs and banks. The intermediaries are going digital, not just the housing finance company or the bank. The intermediaries that the housing companies work with have also going digital and are making investment, therefore making this an imperative. And there's usually this conundrum that exists within the housing finance companies about sourcing in-house versus sourcing through DSAs. Certainly, there are cases that can be made against and for both these scenarios. It finally, there are companies which have 100% in-house sourcing that exists in the housing finance space today. There are companies that have a significant reliance on DSAs that also exist today. So there is no right answer to this. It is something to do with the policies and practices of most of the housing finance companies that will determine which way we go in terms of our sourcing strategy. Talk about regulations. There is a big multitude of regulatory things that are in play as we speak right now. There are as RBI has taken over the mantle of regulation, one of the overarching things that RBI is trying to do is to harmonize the regulations between NBFCs and housing finance companies in general, because they want to make sure that the housing finance companies remain a subdivision of NBFCs, and NBFC-HFI as they call it, HFCs as they call it, rather than having a specialized role that they play. Because at the end of the day, HFCs also do the same job that NBFCs do with a changed collateral. So to that extent, they're trying to harmonize the regulations, whether it is liquidity coverage ratio, the principal business criteria, where the housing finance companies need to exhibit a 60% housing loans in their books rather than remain a MSME lender or a working capital lender. So and they've changed the NPA regulation norms middle of last year, where they've said it's a daily reckon. You reckon the NPAs on a day-to-day basis, just like how the banks do with their end-of-day process, rather than at the month end that the HFCs and NBFCs used to do. I'll talk about the asset light models in a bit. So there are a few things that we've seen over the course of the last few days. Penal charges. They don't want, the regulator certainly does not want us to charge penalty rates, compounding them to the customer. Instead, you have to do a penal charges. There are talks about heritage sites, buildings coming up near the heritage sites that need to be validated by the housing finance companies. So this adds to a list of validations that we do, starting from legal, technical, and a few things that we do. We also have to do one more thing where the sites are not near the heritage sites, etc. The two things that I wanted to talk about in a bit detail is, one is on asset light models. A lot of these things are also giving rise to asset light models. NBFCs are now figuring out if capital adequacy is an issue, and if there are challenges around cost of funds that we can access, then the next best thing is to become a sourcing agent for a bank, and then move towards what started off as securitization and then became direct assignment because of accounting practices. Now there is another method called co-lending, where the HFCs can source businesses and share the risk with the bigger entity, which is usually the bank in most cases, and share the risk in the form of 20% is left with the sourcing company, and then 80% is booked in the destination company, and everything else is managed by the sourcing agent, and with for a fee in return, and of course there is a spread that they make between their lending rate and the cost of funds at which they place the asset. So this I believe will gain traction over the next few years, and will probably find a lot of takers. The other one is the fair lending practices. If you go through, there is a set of fair lending practices that has been issued by the Reserve Bank yesterday. A lot of these fair lending practices are not new. And these are something that you would believe that as a code of conduct, an HFC should in any case have. So it's unfortunate that we need a regulator to tell us what the fair lending practices should be. This is something that as a code of conduct that the HFCs will need to have adopted on their own, and without letting someone else come and tell us. But if you go through this code of the fair lending practices, it talks about transparency. It talks about making sure that the customer is aware of what he's signing up for, and keeping the lines of communication open, and then just don't do anything arbitrarily, etc. But I think that's a step in the right direction, and it's a reaffirmation of things that we anyway should be doing. So I'll move to a few takeaways from a lot of what we see here today. One is there's always going to be a constant tussle between productivity and scalability. Which comes first? We need to be productive so that we can lower our cost to income ratio. Therefore, we can scale better. The other school of thought is that look, if we can grow fast and then scale better, then productivity gains automatically will come. There is truth to both the arguments, but I still think these are not mutually exclusive. These are things that we need to be focusing on. This is I'm sure this is on top of the charts with most of the housing finance companies today, in terms of whether you focus on productivity, do you focus on scalability, and how do you get there, etc. Two, from a growth of AUM perspective, prepayments are a big deterrent for all of us. But we need to understand that prepayments are inevitable. There are lending rate arbitrages that are available. No two companies have shared the cost of funds. So therefore, banks invariably will have a lower cost of funds than HFCs. And as the customer sets up a track record with the HFCs, he will invariably shop elsewhere and then find takers with the banks. And there are intermediaries who will actively churn assets as well. but prepayments are inevitable. This is no longer something that we can, crib and whine about. This is a part of the business. We need to look beyond prepayments and then see how can growth happen despite prepayments. And as I said, banks remain price makers, and banks will continue to mantle that role because of their CASA advantage. We need to figure out a play with the banks in terms of how do we offer, a product differentiation to the customer. How can we go to the customer and service this customer better? Is there a way we can get customer to pay a premium for a lot of things that we currently do that, a banks will probably take a few years down the line? One of the biggest challenges that housing finance companies as we today also face is attrition of employees. Most of my colleagues around the housing finance companies that I talk about attrition north of 30 to 35%. And that is unsustainable in a growing environment. That's almost like saying 1/3 of your sales force or 1/3 of your company will change every year. And then we need to continue to grow at 20% or 30% each year. It's just unmanageable, and that's not going to work. What happens when we start losing people is it's a double-edged sword. A, you lose talent, and then B, you lose time, and B, you also add to cost because the replacement comes at a cost which is higher than your incumbent. So therefore, there are significant challenges that we face because of attrition. So taking care of our employees and managing the workforce becomes a very, very critical growth factor for HFCs. The last point when I say that, look, if your home loan becomes a commodity, banks will win every time. That's the bottom line. The lowest cost producers will always win. So our challenge is, how can I not make this a commodity? How can I tailor it to customers? How can I make sure that the customers get what they want rather than offering it off the shelf on a take it or a leave it basis? That product will always go to the bank. It will never go find a home in HFCs because of the price advantage that the banks have. This is the last slide. So a few thoughts on HFCs and what has not changed. We've talked about everything that has changed over the last few years. What has not changed is the first one is risk management. As housing finance companies, as we see growth everywhere, and as I said, the market has grown significantly. Everybody has grown. So it's a fantastic period to be a housing finance company. But what happens when HFCs show this kind of growth is competition intensifies. Everybody wants to jump into housing finance, banks, HFCs, everybody just jumps in. When everybody jumps in, then what follows is, everybody is chasing the same customer. Your underwriting practices becomes aggressive. So you over-leverage customers, then certainly asset quality accidents happen. Then we all get back to the drawing board and then tighten our policies, etc. So this is a cycle. While we keep saying this keeps happening as well. So this is something that we need to be aware of as fellow professionals in the housing finance space. Secondly, customer service. This is something that I mentioned in my previous point also, where if you don't want your product to become a commodity, you need to focus on customer more than you focus on your own products. If you focus on customers, figure out a way to solve the customer needs, it becomes easy to sell your products. As long as you don't understand this customer, we will always be fighting a rate war with banks, and that's not a winning battle. So customer service is, needless to say, is very critical. And, this is not new. Lending is not about disbursements. Lending is a game of collections. We don't make money when we disburse loans. We make money when we collect the last few installments from the customer. So this is a housing finance, given that we lend for 15 years, 20, 25 years, it's a fairly long game. So we can't claim victory by showing disbursement growth. We need to stay in the game for long enough to know how well are we doing, etc. So this is not a T20. So this is a long game. And greed kills. When people say that market is growing, you can't go wrong. Anybody can anybody can disburse, but if your underwriting practices, if you suddenly start relaxing underwriting practices to catch on the growth wave, it certainly hurts at the end of the day. So this is something that we need to be very, very watchful about. And finally, lending is a boring business. So there is nothing exotic about lending business. We don't, as in the lending industry, we don't get up every day morning and we don't do things differently. We do the same things. We expect to implement a lot of whatever that we talk about better today than we did yesterday, better tomorrow than what we are doing today. So it's just about doing the same thing again and again with a bit of perfection. So it will be boring. You don't do anything dramatically different in sourcing customers. Your underwriting practices don't change every day. Your collections don't change every day. So it's just the same business done well will certainly result in a better management of the portfolio for all of us. So that's pretty much what I had in terms of sharing some of my thoughts. So Kalyan, thank you again for giving me this opportunity to share some of my thoughts. I hope that it did touch upon a few things that you wanted us to cover. So thank you.
Thank you, sir. Thank you very much for the wonderful and very crisp presentation as to how the world is going to evolve. Something which touched me, and I was going through the presentation as you spoke about it. The technology play that you spoke about was so interesting, saying that it's now taken. It's nothing that we are going to, say that we are on the path. We need to be there already. I think that made a lot of sense, saying that it's going to be the in thing. The second important, I loved it, was about the distribution that you spoke about, is saying that the different models are available, but I think every organization needs to take it up, and even the distribution arms of the companies getting into digital space is something which was very interesting observation. And I believe so that large distributors are getting into the digital play, which can make a difference in coming 2 to 3 years. The most important part of the learning was banks versus HFC. That cry which you picked up and say that banks are going to stay, I think we need to understand and need to really deliver very differently than the banks if the HFCs need to survive. The one problem that I've been talking about since 2010-11 is attrition, and you spoke about the 30-35%. Really, it's not manageable, and it's going to be tough. And I think something needs to be done. Organizations need to take care of the attrition problem that you spoke about it. And lastly, last but one, that the game is not about distribution. The game is about collections. I think this is some old adage which always says that my earlier CEO used to tell us that you don't get money by paying. Until to collect the money, you should not even go and disburse the money. So I think that's something which I loved it very much. And lastly, I'm sure business, home finance business is a very boring business, and people need to have a long-term stand. I think it was very interesting, sir. These are some of the big pointers I took it. I would love to hear from others if anybody has got any discussion points. We can take up the questions or some thought process that you have. We can have that discussion over here, and probably Lax will be able to take it up and take it forward. Over to anybody who wants to, they can unmute themselves and speak out, or they can put it on the chat and I can take it up and share it with the speaker, and we can have a discussion on that. So there is one which has come up is Mr. Manikandan has spoken about, saying the Honorable Prime Minister has announced the return of interest subvention scheme during his first day speech. South India, especially Tamil Nadu, has poor performers under PMAY sales compared to Maharashtra, Gujarat and NCR. What needs to be done to improve the situation under the new scheme? So probably what is going to roll out is what is being spoken about. and more focus on South India that he's talking about Manikandan. Any thoughts, sir? Anybody?
I mean, look, we obviously need to see the fine prints of what the new scheme is going to be. But I don't think the previous scheme, did not fare well because of the scheme that it was. I think it was in implementation that it actually fell through because of, there were obviously inconsistencies in mapping the PIN codes versus the properties. So there was large amount of fairly disheartened borrowers came up and said like they originally thought that they were going to be covered, but they did not get covered, etc. I think it is an implementation that we need to focus on rather than what the policy will say. So we'll wait and see what the fine prints are.
Thank you for that. I think there was small, Mr. Devshankar Tripathi sir has given a thumbs up for the presentation and he has loved it in terms of how it has got articulated. Thank you, Dev.
Thank you. He said the benchmark last time when he spoke. So therefore, all we are trying to do is to get closer to that.
Lakshmi ma'am, I love the way you have covered delivery of each and every point. It's really admirable, I'm telling you.
Thank you.
It's a lot of learning for all the youngsters and the professionals who are on the call. How you have to cover in a short time the maximum things. That is the beauty of that.
Thank you very much.
One thing I would like to tell my all participants that these days the green housing finance is getting a momentum now. A lot of these ADB, IFC and other the development bankers overseas, they have been focusing broadly because of the ESG has become now the buzzword. Everywhere you talk, even SEBI yesterday they are saying that how the environment, social and governance has to be taken. So governance, I'm sure that everybody is looking into. Social, all affordable housing finance company, they are doing loan to EWS, LIG, they are covering the social part. The green housing is the area which is still bothering, and it has to gain momentum because by 2030, the government of India has committed that whatever the carbon position was there in 2005, they have reduced by 35% in 2030 and they have become zero in 2070. And housing, it actually consumes 23% of the carbon dioxide gas. So if housing sector start doing something, it will be great. Now there are two things. One is the developer. Developers are now moving towards the green buildings. They are the main actually provider, the large developer who are in generally 50 big districts are there. So they are the one part. Secondly, in the low income affordable, how we can contribute. So I think the self-construction loans which we are giving to the people and they are constructing their independent unit, there if we learn something that how we can advise the customers, it is possible because NHB gives the refinance. First year it is 1% interest rate concession, subsequently 0.25% concession is there that we can pass on a customer. In fact, we have started a pilot run in my company. Awas has done a good job in this. IFL has good job in this. We have also started roughly about 300 houses. We have got green certification, and certification is important, which the GRAH is doing. That is a organization, domestic organization. They have liberalized the terms and they are providing. So my request to my all participants that if you will not start today, tomorrow if you will go to any development lender, he will ask. Probably tomorrow the public sector bank and the private sector banks, when giving loan to you, they can also put a condition in that. And what Mukandan has said, the Prime Minister announcement, I think there may be something may come for the green housing from the government of India side also. That's what I wanted to submit.
Thank you, sir.
With some, so this is something which has come up. So some thoughts have come here. One of the thoughts saying that, would you like to know the reason for high rate of attrition in this field? But I think it's very difficult to respond to that. Anybody would like to pick up on this topic on high rate of attrition in this field? So that was one area which is a sore point for every one of us. But really, is there a solution? I'm not very sure about it.
Yeah, I mean, look, there are a few reasons that we can all talk about. Obviously there are several new entrants in the field, the number of opportunities that people have, etc. But also, the span, the career span that people are looking at. No longer are people looking at saying, I want to join a company and I want to work there for 5 years and 10 years. And now you're talking about, you see CVs where people spend 1 year in every company and then they just move on. So it's more about, as long as people understand that, learning doesn't come in 1 year. I mean, you can't do something in one company and then move to the next company. So you got to take time to learn. It's not easy. I guess, it's eventually it's going to come through. But, I don't think we can find reasons, because these are individuals leaving for different reasons. And, certainly money is one of them.
So while you're talking about, sir, I just want to add a little bit more to it, more not from the industry players' perspective, but from the perspective of individuals. It's not good for them that they keep moving, because effectively they are not actually adding value to themselves in terms of learning that an organization provides. And that's where I have a little bit of a feeling saying individuals need to plan their career, and a short-term strategy would not really make a big difference to them in their career. As they go ahead and they'll realize that later on, it's best that I'm not expecting them to go and stay back for 15-20 years the way probably I stayed in an organization, but I think a good span of time is very much important. I think this is what people realize. And I just want to give this example, like Deshmukh Tripathi sir comes from, as a pure banker, and the years of experience that he had in a banking sector, today he can speak any area of the bank. He can work anywhere. I think hardly any of us can do that exercise the way Tripathi sir does that. Or for that matter, a lot of senior people who stay in an organization in one functional role, they know the market with the back of the hand, that they know everything, what happens, what doesn't happen. They know everything. I think that is something which is lacking at this point of time. So I think this, instead of putting at the organization, individuals need to relook at themselves. This is what my thought process, sir. I thought this is small, I wanted to add to it.
Kalyan, I think you have rightly mentioned it, and what Lakshmi has mentioned, because of some few thousand rupees people are moving. Today the complete job market trend has been completely changed. So what you say, that is a good advice for a person who wants to make his career. If the people are just floating and they are leaving the organization, one, because of the pressure of work, because they are not keen to work for that. Second, the immense opportunity they get. Like if a DST we are paying 15,000 rupees, he goes a delivery boy in Zomato or such companies, he get 25,000 rupees, get a motorcycle and his purpose is served. So he is not bothered for tomorrow. The problem is that he is not bothered for tomorrow. I tell you what Lakshmi had mentioned, it is not 35%. In case of DSTs, it has gone to 75 to 90%. Of course, from last 5-6 months, it has been reduced. And any money you increase, it is meaningless, because that is a spiral effect. You are increasing 5,000 rupees, other company is increasing more 5,000 rupees.
Yeah.
It is adding to the cost of the company unnecessarily. The guy who was worth for 20,000 rupees salary is going to get 40,000 rupees. Same guy works in the bank, handles so many departments. The poor guy gets 25,000 rupees. Here a sales manager gets 40,000 rupees salary. So much of incentive, he is not happy. So what I have tried to find out, you have to find your own solution. Neither this trend is going to continue. These guys will come back after a few years of the salary cut. This trend is temporary because of the hyper demand, expansion by the various NBFC, HFCs, and to get the experienced people is doing. In case of the apprenticeship, I always tell my all friends, the Government of India, Skill Development Corporation and the National Company Law, they both are providing apprenticeship. Apprentice, you can hire a person who is unemployed. Most of the graduates in tier 3, tier 4 cities are non-employable. If you ask them to come, you will not recruit them. But if you recruit them and you give them training, they are very good in credit, operation, technical, other things, excepting in sales. Many are not getting successful. So you get an apprentice at lower cities 12,000 rupees and regular cities 16,000 rupees. Government of India reimburses you 4,500 rupees for every candidate for 12 months. And in 12 months, you are able to shape him and a good person for you. He is definitely going to stay you for 3-4 years. So now the cost to the company, and secondly, 2.5% is mandatory now. You are not feeling the pinch, but sooner or later there will be going to be accountability. 2.5% of total manpower you have to take apprentice. Second part, in CSR, from above 2.5 to up to 15%, now I think it's 25%. If you engage a guy as apprentice, whatever salary you pay, that entire amount you can charge to CSR. It is CSR expenditure. We are required to spend money under CSR. Those companies who are not having CSR quota, they may have to wait for that. But there are many companies, they have spending 2 crore, 5 crore, 10 crore rupees in CSR, and mostly on health sector or in skill development. So why not earlier? Taking guy, skilling him and employing was not allowed under CSR, but now the government of India company law has permitted. So 15% is a good number. Without adding too much of your cost, you can train a guy. In 6 months, he can become like a credit process associate and he start working. And in that, even if 10% you create a bench for you, you are protected from the attrition, if not now, after 6 months. So that is we have been started venturing actually.
I think that's a very good suggestion, sir. That in fact we also have been working with the BFSI Sector Council, and they've been pushing us, saying that why don't you join hands with us? Would love to work on that aspect. So there's one gentleman, Neil, wants to speak out. Mr. Neil Surati, if you want to unmute, please, you can unmute. And after that, so I want Manikandan. If Manikandan you want to speak out, you can speak out, Mr. Manikandan.
So, sir, my point was related to the attrition, and I totally agree that jumping on the salary makes their life easy and they earn quickly. But there are really couple of things. Is one what I believe Dio sir or Lakshmi sir said is what's about the career path and not looking at the short-term goal. So that's one. Second, it's also about the hand-holding from an organization when someone joins. And the second is how the hand-holding happens by a manager. Whether you are in function of sales, collection, credit, operations or anywhere. If the manager's hand-holding is excellent and where he mentors him for the 6 months to 8 months span of time to shape up his role and to actually be productive and deliver what are the KRAs are, then there is a high possibility of building the career in a longer run with the same organization. Because I have worked earlier with this. I have just recently joined Piramal Financials, but before that I was working with Kotak Mahindra Bank, and I've spent 13 years there. So your manager plays very important role in upbringing you within the organization. I think so. This is where the biggest disconnect is, because a lot of managers starts assuming that agar maine hire kiya hai, let him be productive from day one. That's not possible. And that is where the patience goes away. So that was on where how the attrition looks like. Thank you so much.
Laxer, you want to add something?
I think it's a fair point that he raised. Look, while we keep talking about attrition, I mean, there are two sides to that. I mean, it is not just that like employees are jumping up. There are practices, there are things that as organizations that we also need to do. And he's spot on when he said, manager plays a critical role. We need to make sure that we handhold employees and then, do that. I agree with you. I mean, there's certainly things, in spite of doing all of those things, attrition is where it is. Then there is something else that we need to look at, as Mr. Tripathi said. There are other avenues that we need to look at also, and eventually this will settle. But look, organizations need to move on. You can't wait for this to settle down, and you can't pause your growth and wait for things to settle down. So I guess we'll find each organization will find its own answers as we speak, but it will certainly it'll certainly find its way, but it's a question of time, I guess. So
Manikandan, you want to unmute yourself and speak if you are.
Thanks. Thanks, Kalyan. In fact, Tripathi ji covered the opportunities on the apprentice side of things. But then what we probably need to bring it back is the talent management as an investment, especially in mortgages, considering competition is coming from other gig economy sectors. So, and it's that is where I think organizations like Virtuoskill kind of play a role, because it would be difficult for individual organizations to invest and stay invested in talent and capacity building. So at sector level, what you are doing is really fantastic. I know other organizations which are also using your services. So I think if we continue to support such initiatives as a sector, we will grow. Of course, attrition is going to happen. At least we can retain the talent within the sector. That's the point which I wanted to add to what Tripathi had to say. Thanks.
I think just one point on what Manikantan just said, if there is ever an upside of, bogey, that we have also started looking elsewhere. We've also started looking for skills and talent outside of just the HFC community, because otherwise, within the same, 25 companies, you keep looking for one company to the other, and then this just becomes a round robin. So therefore, given the fact that we probably need to bring freshers is one, and maybe even lateral hires, from a different industry, as long as someone understands the fundamentals of lending and risk, etc. So that's also kind of pushing us to look elsewhere.
Yeah. True, sir. True. Very true, sir. I think there is only one last question, sir, and then we will one which come from Sabna. Affordable housing remains a critical issue in India. What strategies or initiatives can housing finance company player adopt to promote affordable housing options for the masses? Yeah, it's a very valid question. I think there are multiple organizations. Sir, you would like to touch upon it?
Yeah, look, every company that's around the HFC table today is making their own approach to affordable housing. Some are already there, and some are really have made a mark, and some are trying to get there. The key to getting the affordable housing strategy done is, make sure that the distribution is in smaller towns, and then we go to the customer and make sure that our processes and products are affordable housing customer friendly. You can't just take a product or a process from, Mumbai, Chennai and Bangalore and then take it to the smaller towns. Everywhere we talk about, eventually the challenge will come down to managing your set of people. Even in a smaller town, it becomes even more critical that you have your people, you have a stable workforce that are there, and then making sure that the strategy succeeds. I guess that's needless to say, because managing your attrition and having a set of people will underpin every strategy that you will do, whether it is affordable housing or prime or any other functional skill that we are talking about. Yeah, I guess every company is making its own unique efforts to reach to the affordable housing. Some are doing it just by footprint. Some are launching aggressive digital tools to get to the smaller towns. So there are varied practices, but I guess the market is kind of accommodating everything right now, because it's a huge market, and in the next 3 to 5 years time, this can only grow from where we are today.
Thank you, sir. I request people to stay back. I just few more minutes, and then we can close the discussion. Sir, from deep my heart, I just want to thank you, and thank you for the wonderful discussion that we had. And we would continue to request you to come back again and again to share your thoughts on different aspects of the financial service sector as we go ahead. I just want to add here that Virtuoskill, as we are speaking about, that we want to do the skill development in the financial service sector, and we had a large focus on the mortgage piece. We are thinking of, and we're going to launch Mortgage Dada, that is a case study contest for professionals, a quiz contest and a case study contest. That's what we are planning to do it. And we're looking forward to support from all the industry players so they can join, and then the learning experience can happen and people can grow. And this is one thing which we wanted to pick it up. I would like to thank all of you only one small suggestion I have with all of you is that please, as we spoke about attrition, one of the big problems that we find is that when you register with your official mail ID, we find that we are not able to send invitation to the next webinar. So even in a monthly webinar, this attrition comes out so much that yesterday we had a huge amount of mails getting returned back because people are using official mail ID. So request to you, register with your personal mail ID so that we can be connected and your learning process can continue. So on the serious note, I wanted to make this happen. And in fact, I was thinking that, oh my God, what is the attrition that has happened in 30 days? So that was the feeling I had yesterday night when I was looking at the entire Excel sheet of all the emails that are returned back. With that, I would like to come to the close of this day's session. Thank you all. And thank you especially to Laksa. You have been wonderful and it's been enjoyable to have you here. Thank you.
Thank you. Thank you, Kalyan. Thank you.